Welcome to the channel. Here we break down real cases and practical insights on business interruption insurance. Let's learn, share experiences, and clear the doubts together. This session is on the business interruption insurance policy. It is usually referred to as BI policy. This presentation is structured in several parts to help you understand both the theory and the practical aspects of this insurance cover. Also learn how to fix the sum insured, decide the indemnity period, and understand the impact of underinsurance and deductibles. Later, we'll discuss different turnover forms, calculation of gross profit rate, and ICOW. This presentation is designed for beginners as well as professionals who either deal with business interruption policies or looking forward to learn it. There's one key condition. However, there's one key condition. The underlying loss must be admissible under the material damage policy. This requirement is known as the material damage proviso. So, to sum up the flow of events. 1. There must first be a material damage policy in force. 2. A covered loss or damage should occur to that property. 3. That damage must lead to a production interruption, either full or partial. 4. The interruption should cause a reduction in sales or turnover. 5. Only then will the BI policy compensate the loss of gross profit suffered during the indemnity period. Eligibility criteria. Who can take this policy? Eligibility criteria. Now let's see who can buy a business interruption policy. There are 3 basic requirements. 1. The insured must have a valid fire or material damage policy in force. 2. The business should be earning a gross profit, meaning its turnover is sufficient to meet all variable expenses. 3. Even if a unit is currently showing a net loss, it can still be covered, as long as it does not have a gross loss. Sales turnover is not enough to cover the variable expenses. In that case, since the business is already operating at a fundamental loss, it cannot be insured under a BI policy. What does the policy pay for? The BI policy compensates for 2 main things. 1. Loss of gross profit suffered during the interruption period. 2. Increased cost of working, ICOW, any extra expenses incurred to reduce or avoid interruption loss. Interruption period versus maximum indemnity period. These 2 terms may often confuse, so let's clarify. The interruption period starts from the date of the loss and continues until the business returns to its pre-loss level of production. The maximum indemnity period, on the other hand, is the maximum time limit mentioned in the policy, say 12, 15, or 18 months, during which the insurer will compensate for loss of gross profit. So, if the business takes 15 months to fully recover, but the insured chose an indemnity period of only 12 months, then compensation will be limited to those 12 months only. Hence, choosing an appropriate indemnity period is crucial. Factors that influence the indemnity period. Several factors determine how long the indemnity period should be. Time needed to repair or rebuild the damaged property. Availability of alternative premises to continue operations. Lead time for machinery replacement or repair, especially for critical equipment. Possibility of local repairs or whether items need to be imported. Availability of raw materials and labor in the affected area. All these practical considerations help the insured decide a realistic maximum indemnity period while buying the policy. Types of expenses: fixed, variable, and semi-variable. Now, let's talk about expenses. Understanding them is key to calculating gross profit. 1. Fixed expenses, standing charges. These remain constant regardless of production or sales levels, such as rent, taxes, depreciation, interest, or administrative salaries. Whether the factory operates or not, these costs continue. 2. Variable expenses. These change in proportion to production, like raw materials, fuel, packing, transport, and direct labor. If there's no production, these expenses stop. 3. Semi-variable expenses. Some costs have both fixed and variable components. For example, power used in the factory is variable, while power for offices is fixed. There may be minimum power demand charges which would be fixed in nature. Similarly, factory labor is variable, but administrative staff salaries are fixed. Accurate apportionment of these expenses is essential before someone compute the gross profit. Gross profit and gross loss. Gross profit is the difference between sales or turnover and variable cost. For instance, if sales are $100 and manufacturing costs are $70, then the gross profit is $30. Gross loss, on the other hand, occurs when variable costs exceed sales turnover, say costs are $100 and sales are $70, leading to a gross loss of $30. A business facing gross loss should not and cannot be insured under a BI policy. Understanding turnover and its components. The total turnover, sales, of a business is made up of net profit, fixed costs, variable costs. So, sales turnover equals net profit plus fixed costs plus variable costs. From this, we can also derive that gross profit equals sales turnover, variable costs. Or, gross profit equals net profit plus fixed costs. In case of a net loss, the formula becomes gross profit equals fixed costs, net loss. These relationships help insurers compute the right sum insured and analyze profitability. Net profit and net loss. When gross profit exceeds fixed costs, the difference is net profit. For example, if the gross profit is $50 and fixed costs are $30, then net profit is $20. Conversely, if fixed costs are higher than gross profit, then the business incurs a net loss. For instance, if fixed costs are $50 and gross profit is $30, the net loss is $20. Deciding the sum insured. The sum insured should reflect the expected annual gross profit, adjusted for any growth trend and the chosen indemnity period. For a policy with a 12-month indemnity period, the sum insured should equal 1 year's gross profit for the maximum indemnity period. If the indemnity period exceeds 12 months, the amount must be increased proportionately. For example, 18 months 1.5 times annual gross profit, 24 months 2 times annual gross profit, 36 months 3 times annual gross profit. Types of turnovers. 1. Financial year turnover, turnover achieved during the full financial year. 2. Annual turnover, turnover during the 12 months immediately preceding the date of loss. 3. Standard turnover, turnover of the corresponding period in the previous year that matches the indemnity period. These figures are compared to understand growth or decline trends, which are then factored into loss computation. If annual turnover is higher than financial year turnover, it indicates business growth. If lower, it reflects decline. Rate of gross profit. The rate of gross profit is simply gross profit divided by turnover times 100. This rate, based on the financial year immediately before the loss, is used to calculate the indemnity payable. Trends and adjustments clause. While computing figures such as standard turnover or rate of gross profit, insurers must adjust them for business trends or special circumstances that could affect performance. These adjustments ensure that the final figures represent the true potential of the business as closely as possible. Increased cost of working, ICOW. Now, one of the most important aspects, increased cost of working, or ICOW. This refers to additional expenses incurred after a loss, with the sole intention of minimizing the reduction in turnover. However, it is only payable if the expenses are both reasonable and necessary, and limited to the amount of gross profit loss avoided. In simple terms, the maximum payable ICOW equals rate of gross profit times reduction in turnover avoided. For example, if a company spends $10 crore to reduce turnover loss, but the resulting gross profit saved is only $6 crore, then the insurer will pay only $6 crore as ICOW. Examples of increased cost of working. Paying a bonus to contractors for completing building repairs faster. Outsourcing production activities. Paying extra to suppliers for priority delivery of machinery or parts. Hiring generators when transformers are damaged. Paying overtime wages to staff to speed up production activities. All these actions help reduce business interruption, and hence, are some of examples of increased cost of working. Thank you very much to everyone for the patience listening. We would be happy to provide the solutions for the practical issues regarding the business interruption policies and claims. You may please put your questions in the comments box.